Hello everyone and welcome to today's session. I was going to say this evening, this afternoon session, but it may not be that time of day wherever you are in the world, but wherever you are, thank you so much for taking the time to come and join myself, Anna, and my husband David, who is sitting behind me, and we are going to be looking at what's been going on in the markets, with in particular the US equities market. It is actually all the US equities markets. We've got some indices to look at, and I think if we've got time we'll also have a look at some commodities. But before we start, as usual, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose, and I really can't stress that more strongly. Right, where do we start? Where do we go first? I think first of all, this literally has popped up on one of my news feeds, because obviously we're going to look at some charts, and in particular the element of volume price analysis that I was going to look at today was something that we call stopping volume, which happens particularly at the end of a strong downtrend. Are you okay?
Yeah, sorry.
Of a downtrend, when there has been a very sharp reversal, a severe correction, and certainly what happened to the markets last Friday, obviously at Thanksgiving, has, it's been variously described as, is it a crash or is it just as I said, a very severe pullback? And the reason that that has been put forward is because of the virus, because there are two narratives that are driving the markets at the moment. One of them is the virus, and in particular, obviously, the new variant that has suddenly popped up. And whenever that has been driving, as I said, it was the prime driver for what happened last week, and we've now had there's been a sort of reversal to that, because people, WHO and other experts have been coming out and saying, well, it's not quite as, it's not lethal. It's annoying, but it's not, as I said, it's not lethal. It's just a variant. Viruses mutate, and this isn't the first. We had the Delta, maybe it's the second, and it won't be the last until this whole COVID thing actually sort of either burns itself out and disappears. How long that's likely to be, who knows? Maybe next year, maybe it could go on even further. But this is, we've not talked about the virus for some time. It's not been sort of headline news. There's been much more the political side of, this about vaccines and whether they should be mandated, etc., etc. Markets kind of pushed it to one side. Then we had this this news about this new variant, and it was for us, it was probably one of the most cynical pieces of, a very cynical move by the market makers to actually, pull the market down at a time when we've now gone into what we call the sort of Santa seasonal rally, as it were, and unfortunately Santa seems to have a bit of a trouble at the moment getting his sleigh out, because as we all know, towards the end of the year, markets like to end on a very positive note. They didn't into 2018, but I think it's going to have a jolly good try to try and end on a on this positive note. What that means, because you have this narrative, or one of the narratives, is you are getting a lot of volatility, which is great if you are a day trader. You just have to trade what you see on the screen. If it's going to reverse, you go short, and if it looks like it's going to go long, you go long. In a way, you've got to kind of insulate yourself a little bit from what is going on around you, but be aware that, as I said, there is this narrative, pushing the price action, manipulated as well. And what I wanted to say, this popped up on my news feed this morning, hit literally before we started. The Dow has been going up quite nicely. The indices have been going up quite nicely, and then suddenly, this came up that because the US has registered the first case of this new COVID variant. The Moderna CEO also came out, and he was a bit sort of saying, well, we're not sure the vaccines are going to be effective against this variant, and bang, the market reversed, as it were. So this going on in the background is going to contribute to the volatility, which we do often have at this time of the year. And also what happens at this time of the year, coming towards Christmas, is liquidity falls. You're coming to the end of year, funds close down. They say, right, good, bad, or indifferent. They draw a line, so liquidity is reduced, and that can lead to big spikes in the price action. The second narrative is the inflation one, and with Jay Powell now having been reappointed the Fed chair, so that's kind of been settled. He was up at Capitol Hill yesterday on his the day one of his 2-day traditional testimony. He's been up today, but yesterday with his sort of trying to explain what he meant by the word transitory, in the sense that he says he has now retired the word, and there's been such a misunderstanding about what does he actually mean by what the market has taken to mean by transitory, and what he has meant by transitory has kind of been two separate things. What I suggest, therefore, because the Fed, obviously, they are the most important central bank in the world, and what they say, certainly now with regards to tapering and maybe the shutting down of bond buying, is going to have a huge impact moving forward in the next sort of weeks and months. And we have the Fed meeting in December as well. You really have to try and get a grip as to, when these characters speak, not just Jay Powell, what do they actually mean? Are they, what are they saying? They use these words. Market has its own interpretation of what he may or may not be saying, and will react. But then after you get the knee-jerk reaction, as we got yesterday, things sort of turn around, and you kind of have to make sense of it. So what we found, or what we suggest, is you need to find a good source. And if you don't already subscribe to a news feed, this is a source that you might like to consider. He's this guy, he's called Brian Chung. He has a very nice Twitter feed. He actually writes for Yahoo Finance, and that's all he does. He just talks about the Fed and interest rates and everything to do with the Federal Reserve. So if you do want to kind of educate yourself and understand, you want someone to interpret this for you, then I think he's a pretty good, reliable source. I follow him on Twitter, but as I said, he does actually write for Yahoo Finance. I actually also have used someone that writes for the Financial Times. You obviously have to pay for the Financial Times, but he's excellent. He's a guy called Robert Armstrong, and he just comments on the US and the US markets. And and the reason I like him, because he's very objective. He doesn't have an axe to grind, as it were. So and that helps me to keep up to date. What do these people mean? Because whenever you get a high risk event, such as the Powell testifying up in Capitol Hill, markets will react. Won't always react in the way you think they're going to react, but once you do get the knee jerk over, then it settles down. And yesterday was a classic example of that. So those are the two narratives. Despite today being a huge day for news, where are we? Just quickly having, I mean, I'm not saying it's irrelevant, but the first week of the month is a big, it's a big data dump. We've got NFP on Friday. It's the PMIs. It gives the market an insight of, if there is it's the cost of purchasing managers index and whether that's going up, and when it goes up, there's an inflection point. The economy is perceived to be doing actually, quite well. Again, you only have to look at Forex Factory. You can see this is Wednesday. This is not all the news today. Forex Factory tends to sort of cherry pick a little bit. If you go over to Trading Economics, which calendar that I've mentioned before, you can see it's been a real data dump today. And this is not, I only have the most important economies. These are the economies that are tied to, these are the G7, these are the 7 currencies that we look at. You can have news from every single economy around the world, and you can see tomorrow as well, it carries on, and so. So it's a very busy start in terms of fundamental news to the month, and obviously it's December, etc., etc. But as I said, I'm not saying this is irrelevant. It is relevant, but the two main narratives at the moment are the Fed, inflation, tapering, the looking forward to what they're actually going to say at their meeting in December, and what is actually going on with the virus at the moment. Let's have a look. In fact, I think the Dow's come right off, hasn't it, David? The YM is now negative. I think it was up, was it up 400-500 at one point? It could be simply one of those, one of these things that, again, it's manipulation. We will have to, as you can see here, the president is also speaking about it. Look at the VIX. The volatility indices are hugely important. I was going to do a whole thing about volatility indices, but I'm going to do it next time to look at them in more detail, because they are also they're a very good pointer as to what is happening in the market, and the level of fear that seems to come in. And what we're having at the moment is these twin emotions of fear and greed, or complacency. They are coming in backwards and forwards very, very quickly, much more quickly than they would, they flip-flop between the two, as I said, driven by the virus and what the Fed may or may not do, the inflation narrative. Right. I said earlier, and this is what quickly we look with regard to now, as always, how do we know that the markets are being manipulated? How do we know that, whether, because with volume price analysis, as you know, those of you who come regularly, those of you who have the books, those of you who are maybe on our Forex program, you will know that a volume price analysis has 5 elements. You've got price action, you've got volume, you've got support and resistance, you've got candles, you've got candle patterns, chart patterns, and you've got time. And what it does is tell you, confirm for you whether what you're seeing on the chart is a genuine move or not. Because unless you are looking at a genuine move, you're trading blind. You can't have any confidence in whether is this actually going to go up? Is it going to reverse and go up? Has it come to a top? Is it going to go down? But at least with volume price analysis, this close relationship with price action and volume, you will have a pretty good idea of whether there is a genuine move or not. And based on that, and based on what has been happening, what I've done this time around, I've just picked a couple of stocks to look at, where one of them is, and one of them isn't. And we're going to look at the concept of stopping volume. But quickly heading over to FinViz, what was interesting yesterday when I put up my usual filters, which are very simple, at the moment I only have the US, I have anything that's over 1 million and anything that has a relative volume of over 1.5. And by relative volume, it's the ratio between the current volume and the 3-month average intraday adjusted. So it's obviously want something that is, there's lots of activity. Basically, you can with this. There's all sorts of all sorts of parameters that you can play around with. But anyway, what I wanted to say was when I did it yesterday, I actually got 38 pages up of stocks. I did it again today, and it's down to 12. What that actually telling me is that there has been a massive amount of activity in the markets at the moment, partly as a result of what happened on Thursday, on Friday, but also because we are coming towards the end of the year, and we only have to look at some of the numbers, the volume numbers. They are truly astronomical, and this also tells you when you do this kind of filtering, because we've done this kind of filtering over the past month or so, and we've only had a few pages. Yesterday I said was 38, so that of itself tells you there's lots of activity. Chances are there's lots of volatility. Volatility and activity is trading opportunity. Now, what you can also do with this is all the sectors. By quickly going through, what it also tells you is which sectors there has been the most, where there's been most going on, as it were. And it's quite interesting. I had another email from one of my other things that I subscribe to, and I must admit I wasn't aware of this. But talking about seasonality, and it's just a general observation. It's not, seasonality is not back testing. It's simply an observation and a statistical look at what happens at particular times of the trading year. And there are three sectors which apparently seem to come to the fore. Basically, one of them is the financial, another is healthcare, and another one is real estate. And with that in mind, I had a quick look to see, well, was that actually confirmed in the filtering? And it did. And it's also, if we look at healthcare here, well, how many pages did, well, healthcare got 3 out of the 12, which is a lot. And then you look at the volume and you think, oh my goodness, there's so, RDX, heavens above, 233 million. I actually think this is my own, from my own studies of cycles, which is a sort of a longer term thing. I actually think the healthcare sector is something that is going to become more prominent maybe next year. It's this is not a recommendation. I'm not saying everyone should pile into healthcare, biotech, but I think it's something that is we're going to be hearing much more of come the new year. And certainly when David and I complete the kind of stock program that we are sort of pulling together at the moment, one of the elements of it will be a look at cycles, and just to explain a little bit more what you look for, and I'm talking cycles over longer periods. I'm talking years, as it were, when some sectors are likely to become more prominent than others. And it's really tied up, a lot of it's tied up with the economic cycle and the business cycle. So that was that. Going back to the actual charts themselves, what happens when you've had such a huge sell-off as we saw on Friday? Corrections, sell-offs, if you read the press, you would think the sky has fallen in, the world has come to an end. But actually, corrections are healthy, and they're opportunities. They are buying opportunities. Particularly when you have had a market that has been it's been a market where it's just buy everything, and everything is sort of overvalued. I'm talking now from a sort of investment perspective. You actually wait for days, periods where you do have pullbacks, you do have reversals, because they become a buying opportunity. You have to remember also, stocks are always, there's a bias to the long side. You don't buy a stock because, you don't buy a stock because, and I'm talking investing here, holding something because you hope it's going to go down, you hope it's going to go up. And if so, already your bias is to the long side. As a trader, you don't really care, because if you are trading it, you're trading the swings, as it were. Do you care whether it goes up or down? No. You will have your tactics in place to take advantage of whichever way it goes. Now, yesterday, this we were looking how do you know after you have such a not a particularly big fall in this one, which is Bristol Myers, which is Bristol Myers, what's the other one? Briggs, that's it, which is Briggs, a pharmacy. Is it Briggs? Are you sure that's the no, that's Squib. What's it called?
Bristol Myers
Squib. Sorry, Bristol Myers is the other one. Is the is the personality test, isn't it? Bristol Myers.
Yes.
Right. And I thought this was a really nice example. The actual number that came in yesterday was something like 25 million, and we can see this suffered like just about everything. It came off really strongly. And what we look for when something has been selling off heavily, you look for those particular chart patterns, candles. What do you see in the chart that could possibly signal that there is a reversal coming? And one of the things you look for first is you look for something that we call stopping volume, because when something is falling and falls, is falling fast, you have to have, as I said, you have to have volume comes in to kind of halt the slide, and it has to be, fairly chunky, as it were. And then the analogy we use is, well, it's a bit like a tanker. You then wait for it to turn, as it were. But with this particular stock, and what happens is, and that's why you end up with a lot of hammer candles. You end up with candles where you have a fall, and then the price sort of is driven back up by the volume that's underneath it. But you don't always get that. What you can often get is you will get the volume coming in, as we see here. This was enormous. It was over 25 million, and you will sometimes see a narrowish spread candle, with preferably with a wick to the bottom, which confirms the fact that there has been this, the buyers have been coming in, there has been this effort to stop the fall and hopefully to reverse it. And what's even more significant here is there was actually a gap down on the day, but if we compare this candle with this candle here and look at the volume, you see the volume that's under this down candle, and then you look, you've got more volume under this one, but it's a narrower spread candle. There's a compression, so there has to be buying under there. There has to be the price support. And to be honest, I'm actually quite surprised that it's had, as you can see here, it's had quite a big push up. The volume hasn't closed off yet, so we will have to wait and see whether that is what came in yesterday is actually going to be enough to sustain it, because obviously this is just the first signal. But it's something to look for when you have had a sharp fall lower, and the first signal that possibly we are going to get a reversal here. But you do have to be patient. The other one that I want to have a look at is actually Robinhood, which is the broker that a lot of new traders use. Now, this is maybe it's not quite so. Let me just go back to the other one again. BMY, because there was something else I wanted to say to that about the support and resistance. I don't have my Camarilla levels on here. The support and resistance, because as I said, that one of the key elements of volume price analysis, and it's price-based support and resistance, but it's also volume-based support and resistance. And this is the volume-based support that is derived from the volume point of control. And what happens with this indicator, the VPOC itself, which is this yellow line here, is what we call the fulcrum of the markets. It's where there has been an element of price agreement. As you can see here, there is a congestion phase, but there's no bias. You can see the price has attempted to rise on a number of occasions. You can tell from the wicks to the tops of the candle, there's been attempts to break away, but it's always gone back in to the towards the volume point of control, and then you get the break lower. And it's nice to see you actually get the break lower with rising volume. What the indicator also throws out are these levels within what we call the high and low volume nodes. Now, a high volume node is where you get a lot of transacted volume. So the histogram will be fatter, as it were. It will extend further over to the left-hand side of the chart. It also means that you've got a dense areas of you've got a lot of volume, transacted volume, so they're quite dense. So when price approaches what we call a high volume node, it can take even more of an effort to actually get through. Where you have then the limit of the high volume node, and you perhaps go into a low volume node, it will then produce one of these bands, as it were. That then produces the support and resistance. And when it is also allied with a price-based either support and resistance line, comes from the accumulation and distribution area, it becomes even stronger. Now, with a low volume node that we have here between here and here, as you can see here, the transacted volume is much less. What happens with price, it moves through there much more quickly because there's nothing in the way to kind of cushion that fall. So then it's hit the last, if you like, the last band, the last volume band from this volume point of control. It doesn't always put this band in. When the band doesn't come in, it probably signifies that it's going to carry on even further. But where it does, most times at the extremes, price will actually reverse. So not only do you have the actual volume coming in underneath this candle, you are also getting a double whammy, as it were, from the volume support from the VPOC itself. So it's just another one of those little confirmation signals that it's useful to look out for. And then if you go up to Hood, to Robinhood, and this is a really good example of Rob, because as you can see here, we don't have this band. So we have rising volume, we still have it falling. I have to say the spread is narrowing because you have there's obviously buying under that little wick there, but it clearly wasn't enough to to push the price further. You have another narrow spread candle here and a slightly wider spread candle, but even more volume going in, but clearly not enough to be able to reverse. Plus we don't think we've got any price. Let me just reload historical data. No, I think that's it. For some reason, my price-based support and resistance accumulation hasn't come up. But it's interesting that of the two charts, it hasn't had the support from the volume point of control. So it should be interesting to see whether this actually carries on a little bit low. But there is volume coming in, and you want to see the spreads narrowing even further. And just as a point of interest here, we had the kind of break from the volume point of control. This is all slightly distorted because the numbers here are so huge now. And kind of, you know, it broke away, but again, volume then acting as a resistance really didn't do much. But the key part of the price action for this chart is when it gapped down lower. Ton of volume came in. It also triggered the volatility candle on this particular candle. The volatility was triggered because it was outside the average true range. What then happens is price will retreat mostly within the spread of the candle, so you can get a little bit of congestion, which we got here. And then, you know, it wasn't enough to reverse it. We have a little bit of volume going in there, yeah, a little bit more under there, then it goes sideways again. But look at the volume under the up candles all the time. You can see they are, it's really not terribly significant. The volume is much higher on the down candles, and these three candles, the volume is actually falling. So, you know, if you'd missed that bit of the trend and then you saw these three candles, you've got wick to the top of that candle, a little tiny wick there, the volume is falling, that is going to tell you this is going to carry on lower, which is, in fact, it's what it has done. So that was that. And the other one I wanted to have a look at was PayPal, which is obviously as a financial one. As I said, we've had a look at Bristol Myers, PYPL. And this also is a stock that's had it's suffered quite badly, actually. It's had a pretty big fall. Again, this also had a bit distorted again by this volume, but very similar to Robinhood. We had a gap down, a volatility candle actually at the volume point of control. The volume point of control can also act as good support or resistance. In this case, it did actually act as some support back into the spread of the candle, straight into some resistance here, not a fantastic amount of volume under the up candles. Then it went back to the VPOC, but this time it did actually carry on lower. And what's been happening since, it's actually been having attempts to rise. So you have got wicks to the bottom of the candle, that candle has responded slightly. We don't have any volume support like the Robinhood chart, and you know, so this one is still looking it's not looking terribly healthy at the moment. It's going to take, you know, if it's going to turn, then it's, you know, the tanker is certainly taking a lot longer than you know, than anticipated, and this is going to have to be, you know, it's going to have to increase quite substantially. So having a look at, I've got others as well, but I want to pass over to David. Those are the ones that I really caught my eye because they were such good examples. Looking at FinViz, go and search out to teach yourself a little bit more about volume price analysis. FinViz will pull up these, you know, this selection of charts with these massive volumes underneath, you know, coming in. You know, where is that volume appearing? Is it at the bottom of a chart? Is it at the top of a chart? You know, the bottom of the chart is really interesting because it you know, it coincides with this concept of stopping volume. Is it enough to stop the fall? Is it enough to stabilize it and possibly become the platform for the move higher? So I'm looking at stopping volume. The opposite of stopping volume is obviously what we call topping volume, but I will leave that topic for another day. Right, if you have any questions, then please just put them into the chat box. Have you done the questions, David, or? All done, lovely. But as I said, just pop them in there, and we will answer them either on air, or I'll answer them in the chat box. But I just want to pass over to David.
Hello, hello, hello. Lovely to be here and good to see you. Just make myself comfortable. Hopefully you can see my screen. Hopefully you can all hear me. Hold on one moment. Just got to check something. Bear with me. Fine. Okay, sorry, just had to check something on the technical side. All good. So hopefully you can hear me. I've got NinjaTrader here. I've got TradeStation down at the bottom here. That's the workstation with multiple stocks. Got Caterpillar on there, multiple time frames. I've got NinjaTrader here, and over on the right-hand side, I've got the Trading View. Just drag that over for a minute. Let's pop that up. There we go. This is basically the currency indices. The pound, not so important at the moment. Certainly the yen is very important, as indeed is the dollar. Both the dollar and the yen rising. You can see this is on 5 minutes, so this is very much intraday. And over on the right-hand side, the euro, which is kind of going sideways and has been for some time. So the dollar and the yen have been rising. No great surprise, to be honest, given what is going on the indices. These are on the dailies and the 5 minutes. So at the bottom, I've got the YM, which is the E-mini future for the Dow Jones. I've got the NQ, which is the E-mini future for Nasdaq, and I've got the ES on the right-hand side, which is the which is the future for S&P 500. I was just looking at that. I just dragged that out. I was looking at this volume here, which is extreme. I'll show you that in a minute. If I show you that now, they're all pretty much exhibiting the same price behavior, which is not. I would say it's not common at the moment because we have seen a lot of divergence, particularly with the NQ leading the way. You may not be able to see it here, but basically there's a huge wick on here, goes right the way up to 46.50. It's come all the way back down again. It's pretty weak at the moment. That said, we are still trading within the spread of the volatility candle, which was Friday's price action. And the one thing I would say to you is this, that whenever you have a holiday, and you will see this across all markets, and let's face it, if you were a market maker, you would take advantage also. It's a great opportunity for the markets to become extremely volatile, to move rapidly, not huge volumes, and to trap traders into weak positions. It's just a classic. You will see it all the time. I can't remember the last example, but there was another one in the past. I think it was to do with the pound, on pound yen might have been. But you will see this all the time. When you get a national holiday of that, particularly in US markets, when you get one of these national holidays, then you really have to keep your wits about you as to what you're doing, either the day before or the day after. Now, if you approach it on the premise from an insider's perspective, those following days do open up multiple opportunities. And the following day we had this reversal. Everyone is expecting the market to crash. What happens? Well, the market reverses. Surprise, surprise, surprise. You do have to view them with some cynicism, and of course you look at it through the prism of volume. And if you see these things going on and you see these big moves, but it's not supported by volume, then it's a trap move. It's been generated with light market volume because most of the traders are not available, and you just have to watch these things all the time. But this is where we are at the moment. We are still trading within the spread of the volatility candle, certainly as far as the ES is concerned. In terms of the NQ, and this is where it differed slightly, we didn't get a volatility trigger on the NQ because the price action was slightly more muted than on the others. So it's trading in a range. It's not trading with a bearish sentiment per se. It is trading, although intraday it is, of course, but it's just trading in a congestion phase, whereas the others are certainly, as far as the YM, which is very different indeed. Huge down day, massive down day, big volatility trigger, as you would expect. But again, you look at the volume, and the volume, yes, the market was truncated on the day, so the volume, you have to bear that in mind. Anna mentioned the seasonality, and one of the things you will see over the next 3 weeks, it's a great time to be trading Forex markets at the moment. I have to say, the run up to Christmas is always good because it thins out and you get quite a lot of volatile price action, which opens up lots of opportunities. Now, you know, you've got to be light on your feet, but as long as you're aware of that, that's absolutely fine. But in terms of seasonality, what you will see over the next 3 weeks is a general decline in volume. And I would say probably by about week 2 in December, you are starting to see the natural decline, the fall off, traders closing up shop for the end of the year, partying, all the rest of it, or maybe not partying in the current environment. But anyway, basically wrapping things up, running down to the holiday season, and then things really only get underway once you get back into really not the first week of January. The second week of January is when the volumes return to what you would expect as normal in inverted commas. So you always have to view volume in that context. As I say, this is the YM, big volatility trigger down at the VPOC. Big down day yesterday as well, decent volume under that one. And we've got a similar, I have got the volume switched off because I've got so much data coming in. But again, you've got a big wick to the upper body, goes up to, where are we? Oops, sorry, I meant to drag the chat box out of the way if I can. There we go. Oops, let's move that out of the way, there. Went all the way up to almost 35,000. It's come all the way down again, 34.5. So, you know, it's come off 500 points. And it's flatlining at the moment, but it's pretty sour at the moment, to say the least. In terms of the 5 minutes, where we're trading, pretty much the same across all three. VPOC up here, so we've broken away from the VPOC. Let's have a quick look and see where the VPOC is there, right up here at the top. And what you're looking for if you're short this market right now as an intraday index trader, you may have not gone in at this level. You may have been waiting. Okay, you're waiting. You're waiting for volume confirmation. Okay, breaks down. We come through a low volume node. And Anna mentioned the VPOC histogram. One of the powerful aspects of having the VPOC is that when you're looking at a trade, you're considering a trade, you're getting into a trade, when the price action approaches these low volume areas, low volume nodes, either below or above, your expectation is that the price should move through there fairly rapidly. Even more so here because you've got nothing in terms of price-based support. These lines here, these dotted lines, these are on the accumulation distribution indicator. They are price-based. The thicker the line, the stronger is the support or resistance region. That's how the indicator works. It does that all the time. It's constantly calculating and recalculating. But when you come down to an area like this where you've got a low volume node, as the price approaches a low volume node, you should expect it to move through there fairly rapidly because there's very little in the way of volume to actually act as support, because volume acts in exactly the same way when you're talking about it this perspective. Remember, all this is up and down here, this is volume, price, and time. Where you're looking at volume and price down here in a two-dimensional linear relationship, if you like, what you're looking at up here is where you introduce the concept of time. So this is volume, price, and time swung up onto the y-axis. So when you come down to this region, what it's telling you is there is a low concentration of volume in that area, and therefore, as a result, you should expect price to move through there fairly rapidly, fairly easily. It's not going to take so much effort to drive through there as it would to drive through a much stronger area like here, or indeed through the VPOC itself, where you've got a ton of volume. So always remember, when you start to look at these things, it starts to break down. We move through here pretty rapidly. Okay, you've missed that move. We had rising volume and falling prices, what you expect to see. Then what do we see? Well, it's not exactly a sign of strength when you get one of these. You know, the volume comes in, decent volume, but the market is trying to rally. You've got a wick to the upper body. At the time, we could have had a series of these. It could have gone up a bit before going. On this occasion, we just had the one, but it's just another indication of weakness. We go down again, then what happens? We start to rally. But what are we doing in terms of rally? Well, generally we've got falling volume on the up candles. Generally speaking, the volume here is also falling. The spread is narrowing in the uptrend. So it's just a signal that it's not a strong sign of a reversal of strength we haven't seen. Anna mentioned stopping volume. We haven't seen strong stopping volume coming in. We haven't seen a shuddering to a stop. Where you see a price waterfall, there's huge momentum behind that price waterfall. Anna mentioned the oil tanker. If you switch the engines off an oil tanker that's moving at full speed, I haven't done it, but I can assure you this would happen, it will carry on for miles and miles under its own momentum. And the same is true of the markets. The market makers and the big operators cannot bring a move of strength that has momentum to a full stop on a sixpence. It takes time and effort. And we explain it fully in the program, but essentially it's like mopping up. If you spill some liquid and you go and mop it up with a paper towel, you don't get it the first time, you don't get it with the second time, you maybe get it with the third time. It's exactly the same principle here. They cannot mop up all that buying pressure or all that selling pressure or take the sting out of the market in a single candle. So that's why you're always looking for stopping volume, you're looking for topping volume, you're looking for that weakness, whether you're looking at it in context of an intraday 1 minute, 2 minute, 3 minute time frame, or whether you're looking at it in the context of a daily, monthly time frame, the principle is exactly the same. So we carry on down. We had a little pivot here, so we carry on down we go, and then market tries to rally again. First candle looks okay, could be a 2-bar reversal, but the volume falls away again. So once again, you've got a market rallying, but the volume is falling, and down we go down to the next level, and then we come down to this low volume node at the bottom, and it looks like now we're moving into a congestion phase. It's not particularly strong. To the upside, we've had a little rally. We've got weakness coming in here. We've got maybe a bit of support here. It's weak again. Looks as though we're going to get another wick on this candle, and on we go. And throughout all of that, of course, you've got the trend monitor at the bottom here, which is a solid red as we break away from the volume point of control and start the downtrend. And it's in these little phases here, and when you get these reactions here, that is when you need this indicator at the bottom, because what it's doing is basically smoothing out your emotion. That's what it's doing. Yes, it's bright red, but if you boil it down to the principle of its design, the principle was to try and give you confidence to hold a position once you're in a strong position and not be bounced out through the emotional trigger of fear of, I've got some profit, I'm going to close it because I've had a run of small losses, so I'm going to take this small profit and bank it because, you know, that makes me feel good. And then 10, 15, 20 minutes later, you're sitting there and the chart is bright red still, and you think, why did I close out? That's the nature, that we're all the same. We all have that emotional response. We cannot help it. It's programmed into our DNA. It's a fact of life. And that's why two things. First of all, trading in multiple timeframes. This is a variant of that, if you like, because what we're doing here is we're trading related markets, these indices, and I'm not saying they always go up and down in the same way. They don't. It just so happens today they are, which is very helpful when you're trading an index. So they are related in that sense. Generally speaking, you've obviously got multiple time frames, but in terms of looking at it through the related prism, you know, this is just as powerful. The trend monitor is bright red across all three. You know, they're all moving in the same direction, and obviously you could do this in multiple time frames as well. And talking of multiple time frames, let's go and have a look. I can't remember which index I've got on the multiple time frame. Okay, I've got the move to the NQ here. That's no problem. Okay. So we're now on the NQ, but you know the principles are exactly the same. And the beauty of VPA, what this symbol is at the top left here, I really couldn't care less. It makes no difference. Clearly, I have to know what it is from a contractual point of view, what I'm actually trading in terms of points or value of points. But other than that, it really doesn't matter to me. It's because VPA is universal. It just applies to the chart and price. That's all you need. As you can see, I've got 15 second up here, 1 minute, 3 minute, 5 minute, 10 minute, and 15 minute. The trend monitor here has been in and out because we had a little bit of a rally. Now it's come back into red, a little bit choppy over here. But as you slowly move out to the slower time frames, 3 minute, and you'll see it here, you know, you had this little rally, and you might be thinking at that point, do you know what? Do I really want to carry on holding this position? We're starting to see some transitional color change come in here. This might have gone to dark blue and then come out into the other side into bright blue, ultimately, if it was a true change, but it only went to darker red. Then it started to transition back into bright red, to come out into darker red again. But if this continues for the next 3, 4, 5 minutes, this will transition back into bright red again. But if you drop down onto the 5 minute, You know, it hasn't flickered at all. It's just remained the same, just stayed at bright red, and of course, out to the slower time frames of 10-minute, exactly the same principle. And all it's about is really choosing your window of opportunity. You know, the 15-second chart up here, I use this a lot. I like it, but I'm not suggesting you should use it. I'm just saying it's one I find extremely helpful, because when I'm trading intraday, I'm trading fast, and this just gives me all the visuals I need on VPA, what's coming up at me. I can see things. I can see where the VPOC is on 15-second. You know, it relates into a 30-second. It goes over to a minute, etc., etc. It's just a very, very fast visual way. All I would suggest, other than trading that particular time frame or using it in your trading, is to use it to practice VPA, because everything happens very quickly. Your chart reading skills will improve exponentially. You will speed up. Whether you ultimately migrate to trading intraday because you enjoy the speed of it, that's entirely up to you. But what it will do, it will hone your VPA skills immensely, I can assure you. Little pivot at the bottom there, the pivots indicator just helping to give a little bit of support to, you know, a minor reversal. The pivots is not a get in, get out signal. It's just giving you that indication of potential changes in the intraday bias, if you like, of strength and weakness. You know, have I got a pivot low? Have I got a pivot high? The way we use it on the education program is very different. It's used to help to confirm whether a trend is underway, whether you're moving into congestion, etc., etc., etc. So that's where we are at the moment. Let's just head over. One of the things I did want to just talk a little bit about is trading on, let's go to trading on non-time-based charts. This is on the Renko optimizer. And again, these are on fast time frames. This is on the 15-second. This is on the Y. We're back to the YM here. Excuse me. So we've got the 15-second, the 30-second. Just going to clear my throat for a moment. Hold on. If you can, darling, that'd be lovely. Thank you. Please. This is on the YM. So we know we're on, if we're on the mini Dow, we're on $5 a point. If we're on the big Dow, we're on 20. Oh, thanks, Simon. We're on the $25 a point. Hold on a minute. I'm just going to take a that's better. So on the mini Dow, we're on $5 a point. On the big Dow, we're on $25 a point. So we're on points here. On the bottom is the standard time-based chart, 15-second, 30-second, and 1 minute. Trend monitor down here. I've got the VPOC on there as well. Up at the top here, this is the equivalent running the Renko optimizer. So this is basically running on 15-second. And if I just click on the 15-second, it will then deliver to me the optimal brick size for this time of day, for the YM, at this time of the session. And if I click on that, that will load up. So basically, we are up here, we are on 13. So each of these bricks is 13 points. In other words, $65 on the mini Dow. So each of these bricks is very profitable. Thank you very much. Over onto the second one. This is on 30-second. Let's just see what this is running at. Just to refresh it, let's go 30-second. This is on 20. And what you will always find is the slower the time frame, then the greater will be the brick size. And finally over to the 1 minute time frame. That's running on 29 at the moment. Just see if that's moved very much. Okay, that's still the same. So this is running at 29 points. There we go. And if you're running on the ES or the NQ, it will automatically convert to ticks, which is the smallest unit of trading. On the YM, it's a point. But the beauty of trading on these, first of all, they're in multiple time frames. And the beauty of setting up a workspace in this way is twofold. First of all, you've got the equivalent time-based chart below. So you can read the VPA signals as they come in. And secondly, using a Renko chart above, you now have a chart which delivers momentum, because the one thing you never see on a time-based chart is raw momentum. The bricks here will build every time 13 points have passed through the market one way or the other, and it will then create the brick accordingly. So that is entirely independent of time. That metric that governs a Renko brick is independent of time. So what you will see on a Renko chart is raw momentum. If the market speeds up and there is a big price move, these bricks will be built very rapidly indeed. Whereas if the market is sluggish, they will not be built at speed. And that's the difference with a Renko chart, with a non-time-based chart. And it's exactly the same with the other non-time-based chart I want to show you, which is tick charts, which works in exactly the same principle, where you see momentum revealed. I've got the trend dots on here. And the other aspect with using the Renko with the trend dots is, as you can see here, the trend dots will change first. They will, here they're pushing down, pushing down, pushing down into congestion. They change to gray, which is what they're designed to do, and then they continue on down. The trend monitor has not transitioned, and it's designed that way because the trend monitor looks at price action over a much more considered time frame than the trend dots. The trend dots work very close to the price action. The trend monitor steps further back from the price action and takes a much more considered view, and therefore does not change so frequently. And as I mentioned earlier on, it is there to help to keep you in. This is a nice example. The price action's reversed. The trend dots themselves have actually gone into blue, but they've then moved the top again. They've gone into gray. They're coming out in red the other side. The trend monitor has had an interim change in color to dark red, but has not actually transitioned any further than that. It's just helping to keep you in. And of course, all of this is read in conjunction with what is going on down here in terms of whether we've got price support, price resistance on the accumulation distribution indicator. Have we got low volume nodes coming up? You know, what do we get? Where are we getting into? You know, the volume here is falling away. We've got a low volume node all the way down here at 40. So there's 20 odd points to move down there. You know, the volume falls away quite nicely there. And you can see all the weakness coming in. You've got wicks to the upper body, you had wicks here, all sorts of things you're seeing down here, which then relates to the Renko chart, which you're trading off at the top here, which reveals momentum. And it's exactly the same with, I haven't shown tick charts for a while, so I thought I'd pull that up tonight. Tick charts, can't remember which one I've got here. It's the NQ now, we're back on. Okay, so we're on the NQ here, no problem at all. The problem with, and it's the same sort of setup, I've got the tick charts at the bottom here rather than the top. So I've got 3 tick charts at the bottom, and I've got 3 time-based charts at the top, the 15-second, the 30-second, and the 1 minute. The big problem with tick charts is knowing what to set it to, because you either guess or you hop into a forum and say, well, you know, I'm going to trade gold. Has anyone got a good setting for trading gold intraday? And someone will say, oh yeah, I trade on 120 ticks or 235 ticks or whatever it may be, which is all well and good. But what you actually need to know is what it should be. And that's why we developed the tick speedometer down here on the left-hand side. What the tick speedometer does in very simple terms, it tells you what setting to create for your tick chart. And that is why this says 377 tick for the moment. Up here it says 377. I'll tell you what this is in a minute. Down here on this middle chart, which is the 30-second one, should be on 610. This is on 481. So I'll just swing that over on Ninja. Just type in the number with a T on the end of it, and it automatically converts to tick. And then the final one is this 1 minute chart over here, which is on 1597. It's actually just changed over here to 987. So I'll just change it over to 987 tick. Oops, sorry, there we go. Okay, so we're now trading at the right frequencies, if you like. So we've got 377, 610, and 987 on the tick charts running along below. Got a volatility trigger coming on 15-second. Keep an eye on that, see if that reverses. We haven't got volatility here. We haven't got volatility on 1 minute. So bear in mind that anything that happens on a 15-second chart has less significance than something on a 30, and that in turn has less significance than something happens on a 1, and so on down the chain until you get to dailies, weeklies, monthlies. Nice move developing, trend monitor's bright red, lovely, 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 nice move here, nice move here, nice move here, all nice and dandy. The tick here is picking up speed. This is now 1597. So we need to just update that. You don't have to, but you know, just keep it in line. This is at 610, this is 377, so we're still trading at the right speeds. The other figure up here is the actual speed. And as you can see, if you were changing this, you'd be changing it literally tick by tick by tick. And hence we've developed this level, which is a an interpretation of the nearest level to the actual, the closest we can get to the actual without, and it's nothing to do with fib other than the fib mathematics to calculate the nearest level to our optimal. You can see it's really moving nicely. You get a sense, and this is what you see on a tick chart, and you'll see it on a Renko chart. You get a sense of momentum when you're watching these. When the market moves quickly, these bricks, or sorry, these candles will come out like a machine gun. They will come out extremely rapidly because they're revealing momentum. You don't see it on a time-based chart, you do on a non-time-based chart. The other aspect of the Renko is twofold. You've got the average speed here, so it gives you a sense of whether we're running at average or below average or above average. And in addition to that, you've got this colored bar below, which signals green is when we've got high activity, orange is medium, and red is when we're in low. So when we're running in orange and green, that's what we want to see. We're seeing momentum, we're seeing activity, we're seeing lots of tick activity, and we know we're in a market that's tradable. When it's sluggish, when you get to the end of the session, it's all bright red. It's very slow and sluggish. The ticks aren't coming in. The Renko bricks aren't building very quickly, and everything is coming to a grinding halt. So what you want to see when you're trading on the ticks and tick speedometers, you want to see green and orange predominantly. Not always. You're going to see red coming in from time to time, but it will be punctuated with green, particularly green when the activity starts to ping in on the tick. And it's just an alternative way to trade as an intraday trader. Now this could be a stock, could be an index, could be a currency future, could be a spot currency, could be anything you like. Makes absolutely no difference. It works in exactly the same way. Really nice move there. Where have we gone from, I don't know, 130, 30, 40 points in there. Really nice stuff. Nice and straightforward and supported by the trend monitor at the bottom there. So I just wanted to highlight those to you because a lot of traders don't use non-time-based charts. We're all familiar with trading on time-based charts. It's all very well and good, but non-time-based charts open up so many other opportunities, I can assure you. It really does. And if you use them in that combination, again, use them in multiple timeframes in inverted commas. In other words, have multiple charts that don't use one. And used in that way, supported by VPA with the time chart below or alongside, however you want to set it up. It's just really powerful ways to trade. Let's just see where we are. No volatility anywhere. Pretty straightforward candle on 5 there, breaking down, coming to down to a low volume node here at the extreme of the candle. So if you wanted to see what's coming up next, you move up to the next one, up to the 10-minute, similar sort of thing. We're getting down to the extreme on the VPOC. You keep going up the channel, go up to the 15, you go up to the 30, up to the hour, up to the whatever. It's just giving you that perspective on where we're going next. So obviously a little bounce rally coming in. If it's actually going to be meaningful, then the first thing that will happen is the trend monitor here will start to transition to a different color. You won't see anything here for 2 or 3 minutes maybe, to see if it does actually bounce into something meaningful, or it's just a minor pause point. That's the low volume node. You saw how quickly it went through there. Volatility trigger on 1. Lots of volume under it as well, so we know the big operators are in there. Down we go. Got a pivot up here, so it hardly looks particularly strong at the moment. Just looks like a little bounce. Having said that, the volume under those last 2 candles there was pretty low. And remember, when you're looking at volume to the downside, you want to see rising volume in the same way you want to see it to the upside. You want to see rising volume because it takes effort to fall as much as it takes to rise. It's as simple as that. It's just been a little bounce, carrying on down, wick to the upper body, away we go, on down, more points, thank you very much. Market's being very generous. The dollar's rising, it's continuing to rise. The yen is still, it's congesting at the moment, it's not going inside, but certainly the dollar is rising. No great surprise, what you expect. So look at this one, there we go. Yep, right, let me just hop over onto the stocks workspace because I've got Tesla over there, which generally delivers, but actually at the moment, unless it's changed in the last few minutes, there we go. This is Tesla on multiple time frames. 1 minute, 2 minute, 3 minute, and onto the daily. Exactly the same principles. And you can see here on the 2 minute, This is on the daily, just pop that up. I think we did a post on this today from memory. We're still trading in this volatility candle. This was the big move when Musk actually dumped a load of shares on the market, and the price reacted accordingly. Big volatility trigger, and we said at the time, you're going to see some congestion. You could see a full-blown reversal, but probably congestion. We've had congestion. We're still trading in that volatility candle. That was weak. Volume under there. It's still looking, it's not looking strong at the moment, but it's a question of being patient and waiting for it to break one side to the other. To the downside, you've got a huge wedge of low volume here. So, if it breaks the downside, it will go through there like a hot knife through butter. So the upside, it's got some work to do to get up to this level here. If it gets up to 1200 and 1225 and beyond, then it's going to break out into the new high ground, or the low volume area up here, up towards 1250 and beyond. But at the moment, it is struggling. No great surprise. But from an intraday perspective, it's struggling also. Normally, as I say, this moves around a lot, and there's lots of trading opportunities, but it's pretty much congested. This is on 2 minute. There are moves, of course there are. We had this price waterfall, then we get a big volatility candle, lots of volume coming in. But look at the trend monitor. We've had the punctuation of congestion phases, but really nothing strongly bearish, strongly bullish developing from it. We had a little 3-candle rally here. The volume fell away, so it's telling you that the effort to rise. If this were rising with any degree or modicum of strength, this would be inverted. You would see this going this way. It's not, it's going the other way. So this is anomalous. It's a VPA anomaly. It's what you're looking for the whole time. To a degree, you're seeing it here. The market rally comes in, the volume falls away a little bit, kind of gets to here, but then rolls over again. But also bear in mind, at that point, we're trading around the volume point of control. So we expect to see congestion building. You've also got this volatility candle. So you were expecting something like that anyway, because you've got a ton of volume under it. And that's what we're expecting, either reversal or congestion into the spread of the candle. So there's lots of nice lessons here. I could spend a long time on this chart. There's an awful lot here that you can pick off, but this is what it's about. It's picking up these things. My eye is always drawn, and any VPA trader's eye will be drawn to either very low volume or very high volume, particularly high volume to start with, because it's easy to pick up. You look at things like this. Is this strong? No, it's a sign of weakness. Why? Because you've got effort to rise. It's really gone nowhere. If that were genuine, then that candle should be up here somewhere. It should have closed nice widespread up candle. It hasn't. Ton of volume going in. It means there's heavy selling coming into that price. So the price has gone up. Sellers have come in, whacked it down. It's not going anywhere. Simple as that. And then you get the rollover into and the other point about VPA is this: when you see these signals come in, you get terribly excited and think, oh great, let's go short. As I said before, with the tanker analogy, things generally take time with VPA. It's not a case of, I've seen a signal, bang, market rolls over and dies. It will often take time. It may well continue on for a little bit, either lower or higher, and then the thing starts to develop. So always bear that in mind when you're applying VPA to any chart, any time frame. Just be patient. You see the signal, you think, great, okay, I've seen that signal. Is it going to be confirmed with the next candle, the next candle, the next candle? You just wait. If you miss one or two, which do reverse on a V shape, in other words, you get a signal, you get a big hammer candle, or you get a big shooting star candle, and the market reverses on the next candle, hey ho, you've missed that one. So what? There's thousands of other opportunities coming along at some point. So don't stress about it.
Sorry, did you make a comment about the dollar or something?
Did I make a comment about the dollar? I did. One of the facts that suggests it's not surprised the dollar is rising, because generally speaking, if the markets are, and this is not, it's not cast in stone, but when markets are weak, you will tend to see the dollar rising, and equally, if the dollar is rising, you will tend to see markets falling. There is, in relational analysis, there is nothing that is cast in stone. You have to bear in mind there are so many other factors at the moment. As Anna said, there are so many different factors influencing the dollar, not least Powell, or the risk aspect. There's tapering, there's all sorts of stuff. The bond, you have to understand the bond markets. it's not just, I wish that trading were just a simple, you know, when you look at fundamental news and you think, oh, good news for the dollar, and you think, right, well, the dollar will rise. I wish it were that straightforward. It isn't, because the markets are not linear in that way. There are so many different facets that come into play. Yes, you know, the dollar is a safe haven, all the rest of it, but you cannot look at it in that very, very simple, one-dimensional view. And that's the reason I threw that comment out. You know, it's just as a comment. That's what you would expect to see, but it doesn't always happen like that. And it's just, you know, it's no surprise at the moment. The yen has flattened off a bit. The dollar, as I say, is still rising a little bit. It's not going up exponentially, but it's kind of climbing, you know, half-heartedly. So, you know, that's the reason for that particular comment. So there we are. We've gone way over time. Sorry about that. Let's just go back and see where we are finally. I've got lots of other stuff here, but we haven't really got time at the moment. Let's just go back there. There we go. There we go. That's on back to the NQ on the multiple time frames. You know, it's still going on down. In a nice little fall here. Rising volume is what you want to see. On we go. Trend monitor again. You can see here it's gone in transitional color, but it's coming out the other side in bright red again. Bright red, bright red. So it's all just helping you stay in, stay in, stay in. Just maximize the profits from, you know, these days are big money days. There are so many days when, and I always remember we've talked to a lot of traders over the years, as you can imagine, and the one thing that is common to pit traders and futures traders in general, I'm talking about the people who trade the pit, the physical pit, is that generally speaking, most of their trading efforts would result in small change. They come out one day with a small loss, they come out one day with a small profit. And where they made their money was on a handful of days where the market was absolutely tanking or it was absolutely exploding. Those are the days when they actually piled in big, made a ton of money, and in a handful of days in the year, that's where they made their profitable trades for the year, and the rest of it was just noise level. That's the way it is. And when the price is moving like this, you know, it's a question of, to use an old phrase, you know, you get in and you fill your boots. You know, if you're scaling in or you're scaling out, however you want to do it, however much, you know, money you want to throw at the market within your trade risk and money management rules, you know, these are days when the market is really moving. And even more so, I would say, in a downtrend, when the market is selling off strongly, boy, oh boy, it moves quickly, because markets will always move to the downside quicker than they do to the upside. 99 times out of 100. And that's why I have a bias to the short side. I make no apology for it. I'm well aware of it. I'm always looking for the opportunities to short the market, because I know for a fact, if I get it right, I'm going to make money an awful lot quicker than I will to the upside. It's just the nature of the game. And if you accept the fact you've got a bias, don't stress about it. I've had it for years. It doesn't worry me anymore. I love trading short, because I know if I get it right, get it at the right time, I'm going to make money quick. Simple as that. Let me just highlight you to the indicators. This is where you'll find them, quantumtrading.com. For TradeStation, a very brief flash up of TradeStation. Sorry about that today. TradingView, hugely popular. TradingView, I have to say, is immensely popular, even more popular MT45. I would suggest it's really gaining some massive traction in the market from what we're seeing. NinjaTrader 7A, hugely popular. We love the platform, and MT45, which we've had for years and years and years. At the moment, I'm sure some of you know what we're doing at the moment. We wrapped up on TradingView. We developed the the cryptocurrency strength indicator for TradingView, and we also built the radar panel. What we're doing on NinjaTrader, we are basically working on the market analyzer. We are updating the indicators. We're adding a lot of things that have been included in other variants. So we're updating them at the same time. And we are also building them all into Market Analyzer, because in the fullness of time, we are going to roll out a comprehensive stock trading program, which will be backed up with a book as well. And in amongst all that, we want to be able to use NinjaTrader as the core platform with Market Analyzer with all that that brings to that particular platform. So that's what we're doing at the moment. And you can catch up with all that on labs.quantumtrading.com. Remember, whatever you've bought from us in the past, and it doesn't matter, we have customers going back 10, 12 years. If you bought something from us 10 years ago, we will have it on the system. And if you decide you want to upgrade to a bundle, or you want to upgrade to a package, or you want to upgrade to the education program, whatever it may be, you will always get a credit for what you've spent with us. It's just the way we work, and we always have done. Having said that, if you invest in the full package with us, again, you get all future indicators we develop for that platform free of charge. Everything is backed up by 24/7 support, and literally is 365 days of the year. We get emails on holidays, high days and holidays, I can assure you, and they're all answered. It's as simple as that. It's the way we operate, and they're answered fast too. So you get 24/7 support, and in addition to that, you only pay once for the indicators, you have them for life. And you never ever pay for upgrades, whether it's for the indicator or whether it's for platform upgrades, whatever it may be. NinjaTrader 7.8 is the same license for both versions you choose. Same with MT4.5. Same license covers both versions. You choose which one you want to use it on. You can flip-flop between the two. This is the Forex program. Won't dwell on it here, but very quickly, we have a lot of stock traders on this now, believe it or not, because over the last sort of 2 or 3 years, stock traders have suddenly woken up to the idea that the Forex market actually sits at the heart of everything, because when assets are converted from one class to another, if you're moving your money from commodities to bonds, or you're moving from stocks to bonds or stocks to commodities, whatever it is, at some point you've got to convert it into cash. So you're going into money at some point. So that flows through the Forex market. So it comes as a great surprise to traders to realize that actually the Forex market sits at the center of it all, around which the others rotate. So we have a lot of stock traders on this now. It's hugely popular. It covers all the essentials of trading. Whether you're a Forex trader or not, Mechanics of Trading module is a universal module applicable to any trading approach. You've got psychology, you've got fundamental, relational, huge deep dive into VPA, forensic study of price and volume, as it says there. And then you've got all these other VPA chart examples, how to use the indicators, pulling it all together, topic webinars and webinar library. It's massive. It's something like 450 lessons, I think, off the top of my head, and it's 250 to 300 hours of video. It's a huge program, but at the end of it, and in addition to that, it's backed up with the VPA Traders Room. At the end of it, you will have all the knowledge and skills you need to trade the Forex market, and indeed any market, with confidence, because you will understand the relational aspects. We've also bolstered in the funded program where you can trade our money at no risk to you. Finally, onto Anna's site. This is where you'll find all the books. They're all up on Amazon, either in Kindle version or in paperback. You'll find them all there. If you're in Kindle Unlimited, then 1 or 2 of them are in there as well, so you'll be able to read them there for free. I think Forex for Beginners is in that class. I think the 3D book is in there as well, possibly Binary Options, and maybe that one, I can't remember now. I think it probably is too. Yep, will do. And there's also some box sets down here, so they're bundled together. So if you want to buy the whole shebang, you can do down there, and you'll find them all boxed together on Kindle. And it says there are a couple of questions. Are there any other periods in the year that are golden for traders on the run? The fact we're trading is just, the thing about the market is always there, and trade. Yeah, sometimes more lively than others. As you'll see, that is particularly one aspect. It's one certainly the run up to Christmas we always find, and it is purely for that reason, because it's such a big holiday period, Mike. And because everyone starts, and it's additionally it's a calendar end of year as well. And because it's a calendar end of year, the portfolios are all closing off, everyone's shutting up shop. So you have this shutting up shop aspect. And that's when you get this confluence of volume falling away, and you are likely to see a price action, volatile price action as a result. And it's similar to the way I said about you know, when you have a big public holiday, it's exactly the same sort of principle. So you do get these big moves, but you've got to be careful because that, you know, they're not all they appear to be. So you do have to be very careful in approaching them. But if you're prepared to accept that and you've been trading for a while, then if you're a novice trader, I would say my advice would be probably not to trade, certainly outside of 7 to 10 days prior to Christmas, I would suggest. If you've got some experience, then I would say it's a great time to trade. But generally speaking, no, it is one of the golden periods, I've got to be honest, certainly over the next 2 or 3 weeks. Around multi-charts. Funny enough, I mentioned multi-charts this morning to Anna. It is on the horizon because multi-charts, as I'm sure you know, are based on the same programming language as TradeStation, and therefore it makes sense for us to work on that particular platform. I cannot give you any idea of when that might be because we are absolutely flat out on NinjaTrader at the moment. But all I can tell you is that if we were to do any platform next, that I would suggest would be top of the list. There would have to be a very strong motive to do something else purely because a lot of the groundwork has already been done in creating the indicators for TradeStation. So that's where we are. Can't make any promises because things change very quickly in this business, as I'm sure you know, but certainly it is on the list to do as probably the next platform in for the development team for that particular reason. So I hope that answers that one for you, Randall. My voice is going, so I'm going to wrap up there. Unless there are any more questions? No, I think that's it. So thank you very much for coming along today. We are back very bright and early tomorrow morning at 7:45. It is going to be a shortened webinar tomorrow because we have to dash out. We've got a couple of appointments that we have to get to. So it'll probably be about 45 minutes max, I would think, on Forex tomorrow morning. But we are back, as I say, tomorrow morning, 7:45 London time. So we will see you bright and early. Thanks very much indeed for coming along today. Hope you've enjoyed it. Enjoy the rest of the trading session, what's left of it. And we will see you tomorrow if you're there. If not, enjoy the rest of the trading week and the run up to the weekend. Have a good weekend. Stay safe in these difficult times. And we will see you again soon. And bye for now.